Hi guys. Today we will analyze Unilever stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. Also recent evolutions are not positive. Both the long and short-term trends are still negative. It is better to avoid buying stocks with negative trends. Strong support levels are around $43.20 and $41.80. Next strong support levels are around $40 and $38.80. Strong resistance levels are around $46 and $48.20. Next strong resistance levels are around $51 and $54. In the last month the stock has been trading between $42.50 and $46.20 range. It is currently trading near the lows of this range. The stock has an average volume of 4 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since June 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around -1% per year, for last 5 years. We see that the average profit margin of the stock has been around 13% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 105% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Unilever Company: bad, average, and good. First scenario. Unilever will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 3%. Future profit margin would be a low, 11%. Future free cash flow to net income rate would be a low, 60%. In this case, the fair value of the stock today would be $62. Second scenario. Unilever will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 11.5%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $79. Third scenario. Unilever will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 12%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $98. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.49. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Unilever, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for Unilever Company: bad, average, and good. First scenario. Unilever will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 3%. Future P/E would be a low, 16. In this case, the fair value of the stock today would be $22. Second scenario. Unilever will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 20. In this case, the fair value of the stock today would be $30. Third scenario. Unilever will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 24. In this case, the fair value of the stock today would be $39. As you can see, today the stock is overvalued, $43, even if we expect the company's high performance in future. While Unilever has a good profitability rating, there are some concerns on its financial health. Also, the stock is expected to show a very small growth, 3 to 5%, in the next 5 years. And the stock has been in a downward trend since June 2021, and the stock can go lower, before it recovers. However, the stock looks almost fairly valued at the moment. I like the stock at current levels, but do your due diligence before buying the stock. The current hostile environment presents big challenges for all staples, including Unilever. Company strengths. Unilever plc is a leading British multinational consumer goods company. Unilever products include food, vitamins, tea and coffee, cleaning agents, water and air purifiers, pet food, beauty products and personal care. Unilever's products are available in around 190 countries. Unilever owns over 400 brands: Dove, Persil, Knorr, Lipton, Rexona Degree, and other. Unilever is the largest producer of soap in the world. Unilever possesses a rock-solid brand lineup along with significant pricing power. Once steady footing is found, both with inflation and geopolitics, Unilever is poised to outperform handsomely. The company has been able to maintain product supplies and keep its factories running during the pandemic. It has also added manufacturing capacity for food and hand hygiene products to respond to changes in consumer demand. The company has announced plans to refine its portfolio and to reorganize its business. Unilever will benefit from new products, further expansion in emerging markets, and ongoing efforts to improve productivity. With a yearly dividend yield of 4.56%, Unilever is a good candidate for dividend investing. Unilever's return on equity of 35%, return on assets of 8%, and profit margin of 12% are amongst the best returns of the industry. Risks. The restructuring of Unilever's complex business structure has hit a roadblock over the past year. Also, Unilever has recently been crushed by geopolitical events in Europe and commodity inflation worldwide, sending shares down 24% from 52-week highs. The company is continually refining its portfolio through acquisitions and divestitures. These deals raise integration risks. Unilever itself has been a mergers and acquisitions target. In 2017, Kraft Heinz offered to acquire Unilever for $143 billion in cash and stock. Although Unilever rejected the offer, it could again become an acquisition target. Unilever, which does business in 190 countries, faces increased competition from startup companies, as well as from local rivals in many international markets. It also faces risks from changing economic conditions, unfavorable currency translation, volatile commodity markets, and political uncertainty. The company is also subject to regulations related to the acquisition of local businesses, as well as to a wide range of labor and environmental regulations. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, Unilever will show a small growth in revenue and earnings per share. The EPS will grow by 6 to 8% on average per year. The revenue is expected to grow by 3 to 5% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.